Welcome to the deep dive. So, you sent us a really fascinating collection of sources this time, all focused on, well, one of the most powerful and, frankly, unpredictable forces in the market today, and that's the rise of the empowered retail investor.
It really is. I mean, we're not talking about small fry anymore.
No, not at all.
We are talking about a consolidated, opinionated, and very immediate source of market influence.
And that context is just so crucial for anyone following the market, right?
Oh, absolutely. What we've seen over the last few years, with popular online brokerages, is a fundamental change in access. They've created this new generation of really active retail investors.
And their collective enthusiasm, their trading volume, it carries real weight now.
A huge amount of weight. If retail can move entire stocks or even sectors, then every serious investor, and that means you listening right now, you have to understand where these retail winds are blowing.
Ignoring them is basically flying blind.
Exactly.
Okay, so let's unpack this and get right to the mission. We've distilled the core reasons for their popularity, the risks, and the potential paths forward for the 5 hottest, most owned stocks on the Robinhood platform as we kick off 2026, all based on the sources you shared.
Yeah, and it's a great snapshot of the market's current obsession. You've got a heavy dose of artificial intelligence plays, a couple of Magnificent Seven members that are, well, they're wrestling with some major geopolitical headwinds.
And then there's this one fascinating outlier.
A profitable outlier that chose to pivot away from all the hype.
We absolutely have to start with the dominant theme here, which is just the sheer influence of AI. I mean, looking at this list of retail favorites, the momentum behind these AI vision plays is it's what's leading the charge.
And what's so fascinating is how that AI narrative has either taken over or fundamentally shifted the investment thesis for even really established companies.
It's less about current earnings.
And much more about the future possibility of, technological dominance.
Okay, let's dive into stock number 1, which is, well, it's a perennial retail favorite, Tesla, TSLA. This has been a core holding for so many people since its IPO back in 2010.
Mm-hmm.
And its controversial CEO has given the company a truly cult-like following that has just sustained it through everything.
And that cult-like following is essential because the sources really highlight that the core electric vehicle business, it struggled at times in 2025.
A lot. Margins were under pressure, competition was fierce.
And yet the stock held its ground, which tells you everything. The market's focus has entirely shifted away from how many sedans they're selling today.
Exactly. The narrative has completely pivoted. It's not about EVs anymore. It's all about those massive future endeavors, full self-driving technology.
A robotaxi fleet.
And the Optimus humanoid robots, eventually. It's not a car company valuation. It's a full-on AI vision play.
And this shift is what creates this incredible valuation tension that Wall Street is debating so fiercely right now. You've got some analysts who look at the patents, the robot integration, and they see Tesla as one of the most innovative AI stocks on the planet.
So they think the price is justified.
They do,
Yeah.
because the total addressable market for autonomous AI is just staggering.
But then you've got the other camp.
Right.
The ones probably looking at traditional auto industry metrics and just scratching their heads.
Yes, and they find the stock, and this is a quote, woefully overvalued.
And they have a point if you look at the multiples.
Oh, absolutely. The sources point out these incredibly high multiples. The market cap for Tesla right now is a massive $1.5 trillion.
With a price around $437.
Right. If you compare that valuation to any other industrial company based on current revenue, it makes no sense.
But the retail crowd doesn't seem to care.
Not at all. They seem willing to pay any price for that future vision. They're essentially treating it like a futuristic tech warrant, not a stock.
That mindset is the perfect bridge to stock number 2, the purest expression of AI dominance, Nvidia. NVDA retail investors have poured into this chip giant, and they have been arguably the most rewarded group in the entire market over the past few years.
Nvidia has become the ultimate pick-and-shovel play in the AI boom. It's a classic. They supply the essential hardware, the chips, the foundational infrastructure needed to train and run every single large language model out there.
Their dominance has been almost absolute.
And the financial results have been just staggering.
And the metric that makes everyone just sit up and take notice is their margins.
Yes. Critically, the sources emphasize these incredible gross margins. At one point, they were in the mid-70s% range.
And they're still at, what, 70%?
Sitting at a very strong 70.05%. Wow. That level of profitability in hardware is nearly unheard of.
Which is why the market has valued them at an immense $4.6 trillion market cap, with a price around 188 pounds. So here's something I found a little counterintuitive. Even with that kind of dominance, the bear case brings up some pretty specific technical concerns. What are the key headwinds that could erode that success in 2026?
Well, this raises a really important question about sustainability, and financial hygiene. On the competition side, of course, investors are worried that competitors like AMD or even internal chip development from a Google or an Amazon could start to erode that market share.
And cut into those spectacular margins.
Right. That's the obvious risk.
But the other concerns I saw in the sources felt a lot more nuanced, almost like financial engineering worries, not just market competition.
They are. More technically, the bears have specific worries about how the company accounts for depreciation of its assets and, this is the critical part, its significant investments in its own vendors and customers.
Okay, so what's the fear there?
The fear is what some analysts have dubbed a circular revenue cycle.
A circular revenue cycle.
Yeah, it suggests the money isn't necessarily being driven by organically expanding customer demand. The bears worry that Nvidia is, in a way, financing its own sales growth by investing heavily in the very companies that turn around and buy their products.
Wow. So if I'm a retail investor, the implication is that some of that incredible revenue might be self-generated in a way.
Or financed, yeah,
Yeah.
rather than purely representing external market penetration. It's a powerful argument for caution.
But what about the bull case?
Yeah.
What keeps this huge momentum going despite those risks?
Well, the primary bull case is still just overwhelming demand. The world needs more AI chips, period. That's undeniable. But the biggest single tailwind the sources mention is geopolitical.
China.
It's China. The potential to get its significant business in China back up and running if U.S. regulatory restrictions were to ease and that massive market fully reopens for Nvidia.
That would be huge.
The sources state it would drive revenue materially higher, and that would override most of those other concerns, at least in the short term.
But if the China business is the main tailwind, isn't that just another geopolitical risk piled on top of the competition risk?
It absolutely is. It adds risk. But the potential revenue is so massive that many investors are just willing to accept that binary outcome.
So it's a trade-off.
It's a trade-off, restriction versus reward. It forces you to weigh execution risk. Can they maintain margins? Against external political risk.
Yeah.
And historically, the retail market tends to bet on the upside of that external risk.
Fascinating.
Okay.
So if Tesla and Nvidia represent this ultimate AI vision and dominance, let's pivot. Let's talk about what happens when that vision gets a bit cloudy. The sources show Apple and Amazon, two crucial members of the Magnificent Seven, struggling.
Yeah, and for a very specific set of reasons that really link them together.
Right, so we need to connect this to the bigger picture.
Immediately. Both companies have been hit hard by a major shared challenge, tariffs and geopolitical friction. The sources are very clear that significant portions of their products, their manufacturing, their supply chains, they're based abroad.
Specifically in China.
Specifically in China. And that makes them highly vulnerable to trade wars and import costs.
Let's look at Apple first, AAPL. It's had a tough run, down about 12% over the past year as of late December, so it's trailing the market. And the two main issues dogging Apple in 2025 were those tariffs and, more famously, a perceived
an AI strategy.
Exactly.
The tariff issue is straightforward. It hits their supply chain and their profitability. But that lack of an AI strategy narrative is where we find this really profound shift in thinking.
Yeah, the critics were slamming them for not spending aggressively on AI infrastructure.
Meaning they weren't shelling out billions on capital expenditures or capex, no massive data centers, no huge chip stockpiles like their peers.
And here is the real aha moment for Apple. That restraint, that lack of capex spending, it surprisingly turned into a huge strength later in 2025.
It did. Investors started to get seriously concerned that other Magnificent Seven members were, and I think the source put it as, spending recklessly on AI capex.
Right, because capex is cash out the door.
And those investments take a long time to yield returns. So Apple's financial restraint, the fact they weren't spending those billions, suddenly looked prudent.
They avoided the market backlash that hit some of their hyper-spending competitors.
They did.
So what does this mean for Apple in 2026? It seems to create two very different paths for them to have a better year.
I think so. Path one is they're seen as a safe haven, a safer bet among the Mag 7, especially if those capex concerns linger for their competitors. Investors looking for stability might flock to Apple.
And path two.
Path two is that Apple could finally develop a strong, monetizable AI strategy sometime this year, maybe through hardware or services,
Yeah.
and they'd be marrying their great business with the AI narrative without having sacrificed billions to get there.
Okay, let's move over to Amazon. AMZN. Also lagging, also hit by tariffs, but for Amazon, the tariff impact is a bit different than Apple's hardware problem.
It is. It hits the e-commerce side hard. A tariff means higher costs for all those third-party sellers who manufacture overseas. So those sellers either have to absorb the cost, which erodes their profit, or they pass it on to the consumer.
Which slows down the price advantage that Amazon's marketplace is built on.
Exactly.
But when you look at Amazon, you see this core resilience that's really unique. They have two completely different kinds of protection or moats against competition.
Absolutely. The first moat is physical. It's logistical. They have built one of the largest, strongest logistics networks in the world.
For rapid, reliable delivery.
That level of on-the-ground infrastructure is, well, it's not going to be replicated anytime soon. That alone is a massive competitive advantage for their e-commerce business.
And then, of course, there's the cloud engine, AWS.
AWS is the second moat, the
Right.
digital one. It's one of the largest cloud players, and its positioning is just fantastic. It benefits from two huge, durable trends,
First is just general cloud migration.
which is still ongoing. But second, and far more critical in this climate, is the massive benefit they get from assisting businesses in running large language models and other AI workloads,
So they get to capitalize on the AI wave as a service provider.
without shouldering all the development risk that, say, a chip maker or a specialized AI model developer has to face.
Okay, so we've covered 4 of the 5, and they are all fundamentally linked by AI or geopolitics. Now we hit the outlier, the one that is explicitly not an AI play and represents a completely different philosophy. Ford Motor Company. Symbol F.
Ford is such a brilliant case study in strategic pivoting and what the market is rewarding right now. The stock actually performed well precisely because it showed a willingness to abandon a costly path.
And instead focus on profitability.
Exactly.
Okay, so let's unpack that pivot. They moved away from trying to mass-produce high-cost EVs. Where did they refocus?
They pivoted hard to focusing on hybrids and internal combustion vehicles, things with a clear, established path to profitability.
It sounds like a brutal decision.
It was. And it had a substantial cost. Ford is taking a whopping $19.5 billion charge as a result of writing down the value of their EV investment.
Wait a second. The market shears a massive, nearly $20 billion loss. That seems completely backward.
It sounds backward, but it tells you everything about investor sentiment right now. The sources noted that investors were relieved to see the shift.
Relief.
That relief signaled that Ford was prioritizing cash flow and earnings over a high-cost, high-uncertainty future. It's relief from future bad decisions and mounting losses in the EV division.
And I imagine the strategic choice was heavily informed by the challenging political and market context for EVs.
Absolutely. The EV market is facing major headwinds. The prior administration eliminated the $7,500 federal tax credit.
And the sources say EV policies under the current administration are unlikely to improve significantly.
Right. And the market is saturated with competitors. Consumer demand isn't keeping pace with those earlier aggressive projections. Ford is just reading the room.
And choosing profit today over rapid high-cost expansion tomorrow. Right. But for a long-term investor, isn't abandoning EVs just delaying the inevitable? Is this short-term profit at the cost of future growth? Or is it just smart management?
And that is the central debate for Ford. The bulls say it's smart management. They're funding their future through current profits from high-margin trucks and hybrids. It gives them control.
While the bears argued they're falling behind the technology curve.
But the market right now is clearly rewarding the former.
And that focus on bottom line is showing up in their financials, which I guess is the final piece of the puzzle.
Precisely. The financial health indicators are positive. Ford recently raised its 2025 guidance for adjusted earnings before interest and taxes EBIT.
And reaffirmed its free cash flow guidance.
Exactly. Plus, for an income-oriented retail investor, they offer a very attractive, roughly 4.5% trailing 12-month dividend yield. It's a pure profitability and income play.
A sharp contrast to the speculative AI exuberance we started with.
A complete contrast. If we connect this to the bigger picture, across all five of these stocks, three big themes really jump out. First, the overwhelming influence of AI. It's not just a sector anymore. It's an entire investing thesis that's even shifting the focus of a legacy company like Tesla.
Away from selling cars and towards valuing them based on robots and software.
Second, the major impact of geopolitics on the world's biggest companies. These tariffs aren't abstract policy. They're measurably hitting giants like Apple and Amazon.
Causing them to lag the market and forcing them to rethink their entire supply chain.
And third, the market is demonstrating a clear preference for a clear path to profitability. We see it with Ford's pivot.
And we see it paradoxically with Apple, whose lack of reckless AI spending was seen as a financial strength.
The market is cautious about burning cash for future promises.
This has been a really comprehensive look at these sources, and hopefully you now have a much sharper view of why these five stocks are dominating the retail market. And monitoring these trends is just essential now. Their collective conviction influences professional money more than ever.
Absolutely. The tension between that AI exuberance, where investors are chasing the highest multiples for the biggest vision, and the caution we see, in the reward for concrete profitability, that is the central narrative of early 2026.
The retail crowd is essentially split.
Between investing in the future that must happen, which is AI, and the profits that are happening, which is Ford.
So we'll leave you with one final provocative thought to consider, building on everything we've discussed. Given the retail crowd's overwhelming focus on future potential, Tesla's robots, Nvidia's dominance, and the contrasting market reward for clearer profitability, Ford's pivot, Apple's capex restraint, where does the risk truly lie for retail investors in 2026? Is the safest bet in the stock with the biggest, most compelling vision, or is it the stock with the clearest, most demonstrable path to profit right now? Something to mull over until our next deep dive.